Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on capital lease versus operating lease. And we'll be looking at some of the differences. So let's get into nitty-gritty of the same. First, we'll understand the difference between the capital lease and operating lease. Lease is, I'll first write for you over here, cap and operating lease. Lease is contractual agreement between the lessor, that is the owner of the assets, and the lessee, that is the who rents the asset. So it's lessor and there is one called lessee, right? So there are two parties. These are classified into two. One is called the operating, another one is called capital lease, depending on how the risk of the ownership and the benefits have been transferred. What is lease at the very first end? See, lease is an arrangement by which the lessor, it conveys to the lessee in return for the payment of series of payment, the right to use and the assets for the agreed period of time. So in an agreement of the lease, the lessor and the lessee enter into an arrangement in which the lessor transfers the right to use an asset to lessee against a payment of the lease rental for a period of time. So in some cases, if mentioned in the agreement, or according to the term and the condition of the lease, lessee has a right to acquire ownership of the assets and the lease at the end of the lease period. So before we proceed, you should know the difference between the lessor and the lessee. Now, the lessor is the captive leasing company, banks, or other independent, and the lessee, in case, are like transportations like trucks, aircrafts, real estate buildings, construction, agriculture, and so on and so forth. So before we look into the difference of capital versus operating lease, let's understand each of them in detail. First, the operating lease. The operating lease is stated as a lease arrangement which does not involve the transfer. It does not involve any transfer of the substantial risk and rewards of the ownership of the assets leased to the lessee. Operating lease generally have a period which is less than the fair value of the assets leased. Now, leases that do not meet any of the four criteria are accounted for an operating lease. The first test is that there should be a transfer of the ownership, like the test one for the capital lease versus operating lease is that transfer of ownership. Transfer of ownership is the first difference. Second, test 2 for the capital lease versus operating lease is that the bargain purchase option. That is the second point of difference. If yes, then capital lease, and if no, then the operating lease. In case of transfer of ownership, again, if yes, then capital lease, if no, then the operating lease. The third test that you need to go for capital versus operating lease is that the lease term. If greater than equal to 75% of the economic life, yes, then capital lease. If no, then operating lease. And finally, the test 4 for capital lease versus operating lease is the present value of the payments. The present value of the payments over here, if it is greater than equal to 90% of the fair market value, if yes, then capital lease. If no, then operating lease. Now, let's look at the accounting treatment of the operating lease. Now, in the books of lessee, the operating lease does not result in recognition of assets or liability on the balance sheet of the lessee. Lease payments other than the cost of the service like insurance, etc., should be recognized as an expense on the straight line basis in the profit and loss account. However, if there is some other basis which is more representative to the time pattern of the user's benefit, then lease payments should be recognized using that basis. Now, in the books of lessor, an operating lease should be accounted for in the following manner. Like, the transaction is not transaction of sale, hence no selling profit is to be recognized. Second, the assets given under the operating lease is to be shown in the balance sheet under the fixed assets. Cost including like depreciation is recognized as an expense. That is, the depreciation is to be charged in accordance with the normal depreciation policy of the lessor. by allocating over the lease term in proportion of the recognition of the rent income, by treating them as an expense of the period by which they are incurred, that is by taking them to the profit and loss account of the year. Now let's look at the accounting treatment of the capital lease. Capital lease. In the books of lessee, if you talk about, in case of capital lease, the recognition of the lease as an asset and the liability at the inception of the lease should be recognized at the fair value, okay, of the leased asset at the inception of the lease and not exceeding the present value. Not exceeding the present value of the minimum lease payment from the lessee's perspective. So present value of the minimum lease payment is to be calculated using the IRR method over here. Now in the books of lessor, the capital lease should be accounted in the manner as in the balance sheet the leased assets are recognized as debtors or the receivables at an amount equal to the net investment in the lease. The lease payments related to the accounted period other than the cost of the service are reduced from both the principal and the financial earned income. The finance income is allocated over the lease term in the manner that return on the net investment outstanding for the various period in the constant, and unguaranteed residual values are reviewed regularly. Let's see one example of capital lease. See, in case of let's say ABC Limited is in a rail company which has been leased out generator from DEF Limited to provide backup to the transporters system during the power outage. So the lease period is close enough to 6 years. The term in which ABC Limited has is $4 lakh in terms of payment to DEF at the end of each year, and the rate of interest implicit to the lease is close enough to 10%. So the present value factor for the 6 years for the 10% is 4.355. Let's see how the answer goes. The present value of the over here, as we just understood, the present value of the minimum lease payment is equal to 4 lakh, that is the payment, into the present value factor, that is over here 4.355, which will give you 1724,000. Now, how does the analyst perspective on the capital lease accounting work? I'll show you an effect on the balance sheet, how things work out. If you see the balance sheet impact, there is no impact on the balance sheet of the lessee. The operating lease at the inception, that is the assets is equal to liability plus shareholders equity. There will be no entry over here, no effect over here. The end result will be no effect. There will be no changes. Operating lease as a payment are made. So the assets is equal to liability plus shareholders equity. Over here the cash will reduce because of the periodic payments that have been made, and over here the shareholders, the flows through the income statement as a rent expense. So accordingly your shareholders equity will also reduce. So now let's consider the effect on the income statement. See, the interest payment, that is the discount rate, the effect on the income statement, that is the interest expense. So in case of interest expense, the discount rate at times the lease liability at the beginning of the period. The second is the depreciation period calculation in case of income statement effect. If the lease transfers the ownership, then depreciate the assets over the economic life of the asset. If the lease does not transfer the ownership, then depreciate over the term of the lease. Now the effect on the cash flow. Let's understand the effect on the cash flow. Now in this case, only the portion of the lease payment that is considered as interest payment reduces the CFO, and part of the lease payment considered payment on the principal reduces the CFF.